This is the document they hoped nobody would read carefully. Not a treaty violation, not a military order, not an executive action signed in the Oval Office with cameras rolling and aides applauding. Just a single paragraph, buried on page 47 of a routine Federal Reserve policy statement released at 2 p.m. Eastern Time on Wednesday, April 8, 2026, announcing that the Federal Open Market Committee had voted 7-5, the most fractured vote in 23 years, to hold the federal funds rate at its current level despite core inflation running at 4.1% annually, explicitly citing, for the first time in the institution's 112-year history, geopolitical supply chain disruption attributable to ongoing conflict and route denial as a primary determinant of monetary policy. 7 words that most people read past without stopping. 7 words that, to every sovereign debt trader, every central bank governor, every currency strategist, and every finance ministry official who understands what they actually mean, represent something that has not happened since the stagflation crisis of the 1970s. The Federal Reserve publicly admitting that it cannot simultaneously control inflation and accommodate the fiscal demands of a government fighting a multi-front geopolitical crisis. The most powerful central bank in the history of global finance just blinked. And the chain reaction that single blink has triggered in currency markets, in sovereign debt spreads, in commodity pricing, in the security calculations of American allies and adversaries alike, is moving through the global financial architecture with a speed and a breadth that no single institution, no coordinated policy response, and no amount of official reassurance is currently positioned to contain. This is Wednesday, April 8th, 2026. Buckle up, because what follows is the full account of how one decision by 7 people in a room in Washington has set in motion a sequence of events that will determine the cost of your mortgage, the value of your retirement savings, the price of every imported good on every shelf in America, and the credibility of the security architecture that has kept the major powers from open conflict for 80 years. Here is what you need to understand before we trace exactly how this chain reaction is propagating the Federal Reserve's independence, its institutional separation from the fiscal and political priorities of the government. It nominally serves as not merely a technocratic preference or an academic principle, it is the foundational credibility mechanism of the entire dollar-denominated global financial system. Every foreign central bank that holds dollar reserves, every sovereign wealth fund that prices its assets in dollars, every multinational corporation that invoices its trade in dollars, does so on the basis of a single underlying assumption that the institution responsible for managing the dollar's value is guided by price stability, not by political necessity. The moment that assumption is credibly challenged, the moment the market concludes that the Fed is setting policy to accommodate fiscal deficits and geopolitical priorities rather than to control inflation, the premium that the dollar commands as the world's reserve currency begins to erode. And that premium, as previously analyzed in this space, is worth approximately $100 billion per year in borrowing cost savings to the U.S. government. It is the financial foundation of American strategic power, and the 7-5 vote, with its explicit citation of geopolitical disruption as a policy determinant, has just placed that premium under the most direct challenge it has faced since Paul Volcker raised rates to 20% in 1980 and broke the back of inflationary expectations through sheer institutional willpower. The current Fed chair has done the opposite. He has accommodated, and the market is now pricing in what accommodation, once begun historically, leads to understand the specific mechanism through which this decision triggers a global chain reaction rather than simply a domestic monetary policy debate. You have to understand the 3 simultaneous pressures that produced the 7-5 vote and why their convergence at this particular moment is structurally different from any previous Fed policy stress episode. Pressure 1 is the fiscal position. The United States federal government is currently running a deficit of approximately $2.1 trillion annually, roughly 7.4% of GDP, at a point in the economic cycle when, by every conventional macroeconomic metric, the deficit should be contracting rather than expanding. The deficit is being driven by 3 simultaneous spending demands: $847 billion in mandatory interest payments on the existing $34.6 trillion debt, and $967 billion in defense spending, reflecting the security commitments across Ukraine. the Pacific Deterrence Posture, and the Persian Gulf Force deployment, and $340 billion in emergency supplemental appropriations passed in the last 18 months for allied security assistance and domestic infrastructure resilience. The Treasury is financing this deficit by issuing approximately $8.9 trillion in new and rolled over debt per year, a number that has caused the term premium on long-dated treasuries to rise to its highest level since 2007, because the market is beginning to question whether the supply of new issuance can be absorbed at current price levels without yield increases that make the deficit even larger. Raising interest rates to control inflation in this environment directly accelerates the deficit by increasing the interest cost on the new issuance. The 7 members who voted to hold understood this arithmetic. The 5 who voted to raise understood what holding means for inflation expectations. Both sides were right about the problem they were identifying. Neither had a solution. Pressure, too, is the geopolitical inflation component, and this is the dimension that makes this crisis genuinely novel in the post-Bretton Woods history of American monetary policy. The 4.1% core inflation figure that the Fed is failing to bring down is not, according to the most granular decomposition available in the Bureau of Labor Statistics data, primarily a demand-driven phenomenon of the kind that monetary tightening is designed to address. It is a supply-side structural phenomenon driven by 3 converging factors that interest rate increases cannot resolve. The Red Sea corridor closure, which has added an estimated 340 basis points of inflationary pressure to shipping-intensive goods categories through the Cape of Good Hope diversion cost, the semiconductor supply chain fragility exposed by the Taiwan Strait tension, which has kept electronics component prices elevated and production schedules compressed, and the energy price volatility driven by Persian Gulf military posturing, which has kept fuel costs approximately 23% above their pre-2024 baseline across the transportation sector. Raising the federal funds rate does not reopen the Bab-el-Mandeb. It does not resolve the Taiwan cross-strait tension. It does not bring Iranian drone production to a halt. It inflicts real economic pain on American households and businesses. Tighter credit, higher mortgage rates, slower hiring, without addressing the supply-side causes of the inflation it is nominally targeting. The 7 members who voted to hold were making a rational assessment of monetary policy's limits. The market, however, does not grade on limits. It grades on outcomes. And the outcome, 4.1% core inflation with the Fed standing still, is being graded as institutional failure. Pressure 3 is the international dimension, and it is the one that transforms a domestic monetary policy miscalculation into a genuine global chain reaction trigger. The dollar's exchange rate against every major currency is determined at its most fundamental level by the real interest rate differential between dollar-denominated assets and the assets denominated in competing currencies. When the Fed holds rates while the European Central Bank, the Bank of England, and the Bank of Japan are all either raising rates or signaling continued tightening to address their own inflation dynamics, the real interest rate differential narrows or, in several cases, inverts. Capital flows toward higher real yields. The dollar weakens. A weakening dollar makes U.S. imports more expensive, which is inflationary and which makes the Fed's stated goal of controlling inflation even harder to achieve without the rate increases it just refused to make. This is the spiral. It is not hypothetical. It began in the 47 minutes following the release of the Fed statement on Wednesday afternoon. The dollar index, the DXY, which measures the dollar's value against a basket of 6 major currencies, fell 1.8% in that 47-minute window. That is not rounding error. A 1.8% intraday move on the world's reserve currency is an event that appears in the historical record approximately 6 times per decade, and every previous occurrence has been associated with a significant subsequent repricing of dollar-denominated assets globally. Gold rose $67 per ounce in the same window. The 10-year Treasury yield rose 14 basis points, meaning the market immediately demanded higher compensation for the inflation risk that the Fed just implicitly validated. Sources inside 3 primary dealer institutions described the trading floor environment in the 47 minutes following the statement as the most intense they have experienced since the March 2020 COVID liquidity crisis. Here's the catch: the second-order effect that nobody in the financial media is explaining clearly enough. The 1.4 basis point rise in the 10-year Treasury yield that occurred within 47 minutes of the Fed statement is not just a bond market data point. It is a global cost of capital event. every sovereign borrower on earth that issues dollar-denominated debt, and there's 67 of them, with approximately $4.3 trillion in outstanding dollar-denominated sovereign bonds, has just seen the reference rate against which their borrowing costs are priced move adversely for the United States government. A 1.4 basis point yield increase on its $34.6 trillion debt base represents approximately $48 billion in additional annual interest expense if the move persists through the next refinancing cycle. For emerging market sovereigns that borrowed in dollars during the low-rate environment of 2015 to 2021, countries like Egypt, Pakistan, Kenya, Ecuador, and Sri Lanka, which are already operating under IMF restructuring programs, are on the verge of seeking them. A persistent 1.4 basis point increase in their dollar borrowing costs can be the difference between a manageable debt service burden and a sovereign default event. Sources inside the IMF's Western Hemisphere and Asia-Pacific departments describe the current emerging market sovereign debt stress indicators as the highest since the 2013 taper tantrum, and the 2013 taper tantrum produced a wave of currency crises across 14 economies. The Fed's decision to hold did not calm the emerging market debt environment. By signaling inflation tolerance and dollar weakness simultaneously, it has made every dollar-denominated debt issuer outside the United States more vulnerable to the exact refinancing stress that precedes sovereign default cascades. Nobody in the mainstream coverage is connecting the Fed's Wednesday decision to the specific geopolitical chain reaction it accelerates in the Gulf, and that connection is the most consequential link in the entire sequence. Here's the mechanism. Saudi Arabia and the UAE peg their currencies, the rial and the dirham, to the US dollar. Currency pegs require that the central bank of the pegging country holds sufficient dollar reserves to defend the fixed exchange rate under capital outflow pressure, and that it broadly align its own monetary policy with the Fed's to maintain interest rate parity and prevent destabilizing capital flows. When the Fed holds rates while inflation runs at 4.1%, it is implicitly accepting a negative real interest rate in dollar terms for Saudi Arabia and the UAE, which are experiencing their own inflationary pressures from the same geopolitical supply chain disruptions. Accepting a negative real interest rate in the currency their economies are pegged to is economically damaging and politically costly. The pressure to repeg or to move to a currency basket arrangement that gives them more monetary policy autonomy increases directly with each month that the Fed tolerates elevated inflation without responding. Sources inside the Gulf Monetary Council describe the current internal discussion about the dollar peg as the most serious since the 2008 financial crisis. The Abu Dhabi Alternative Reserve Architecture, discussed in these pages previously, the commodity-backed settlement instrument being developed as a dollar alternative, gains urgency and accelerates its recruitment timeline with every quarter that the Fed's credibility is visibly eroded. The chain reaction does not require a dramatic rupture. It only requires that the incremental cost of maintaining dollar alignment exceeds the incremental benefit, and a Wednesday decision moved that calculation measurably in the direction of departure. The psychological dimension of the Fed's decision, what it signals about institutional capacity and political will at the highest levels of American economic governance, is the variable that amplifies every other effect in the chain reaction. Here is what the global investment community, the sovereign wealth fund managers, and the foreign central bank governors are reading into the 7-5 vote. They are not primarily reading a monetary policy judgment. They are reading an institutional stress fracture, a 7-5 vote, with a dissent rooted explicitly in concern about the Fed's institutional independence from geopolitical pressures, signals that the FOMC is no longer operating as a unified body applying a shared analytical framework to a shared data set. It is operating as a divided committee in which political and strategic considerations are being weighed openly against price stability mandates. That is an institutional posture that, in the historical record of central banking, has preceded every major inflation de-anchoring event of the past century. The Bundesbank's resistance to political pressure in the 1970s and 1980s produced German price stability and the institutional credibility that eventually made the euro viable. The Bank of England's capitulation to Treasury pressure in the 1970s produced double-digit inflation, a 1,976 IMF bailout, and a decade of economic dysfunction. The Fed's Wednesday vote will be studied by monetary historians as the moment the institution chose the English path. The market understood this in 47 minutes. The full consequences will take considerably longer to manifest, but they are now structurally embedded in the financial architecture in a way that a single subsequent hawkish statement will not undo. Worst case scenario, the chain reaction achieves critical mass within 90 days through a sequence of 4 linked events, each of which is individually probable at better than 50% odds, and which, in combination, produce a systemic outcome that is far more severe than any single element. Event 1, the dollar continues weakening against the euro, yen, and yuan over the next 30 days, pushing the DXY below the 95 level that historically signals sustained dollar weakness rather than a transient correction. Event 2, 2 emerging market sovereigns with significant dollar-denominated debt, the most likely candidates, according to sources inside the IMF's Financial Stability Division, are Egypt and Pakistan, both of which are operating under existing IMF programs, with maturity walls approaching in the third quarter of 2026 minus. Unable to refinance their dollar obligations at sustainable rates and request emergency restructuring, triggering contagion selling in the broader emerging market debt asset class. Event 3. The contagion selling in emerging market debt forces several European and Asian financial institutions with significant emerging market exposure to mark losses that breach regulatory capital thresholds, triggering forced deleveraging that pressures credit markets globally. Event 4, Saudi Arabia announces a formal review of its dollar peg policy, citing monetary policy divergence as the primary driver, and simultaneously confirms that it will invoice 30% of its 2026 oil exports to China in yuan rather than dollars. Each of these events is containable in isolation, in sequence, within 90 days. They produce a dollar confidence crisis that the Fed, having just demonstrated it will not raise rates to defend the currency, is poorly positioned to arrest. That is the worst case. It is not the base case. But sources inside 3 central banks and 2 primary dealer institutions describe its probability as uncomfortably non-trivial. The historical weight of what the FOMC voted to do on Wednesday afternoon cannot be fully understood without reference to the 1970 stagflation episode, the last time the Federal Reserve faced a combination of supply-side inflation and geopolitical fiscal demands that exceeded its institutional willingness to impose the economic pain required to maintain price stability. The parallels are specific and disturbing. In 1973, the Arab oil embargo created a supply-side inflationary shock, the direct analog of today's Red Sea corridor closure and energy price volatility that the Fed under Arthur Burns chose to accommodate rather than suppress, partly because the Nixon administration was applying political pressure to avoid the recession that aggressive tightening would have caused. Burns' accommodation allowed inflation expectations to become unanchored, to embed themselves in wage negotiations and price-setting behavior and long-term interest rate structures in a way that took 7 years, 2 recessions, and Paul Volcker's unprecedented 20% federal funds rate to reverse. The total economic cost of that accommodation, measured in cumulative lost output, elevated unemployment, and destroyed savings, was estimated at the time at $1.3 trillion. In today's dollars, that is approximately $5.7 trillion. The Wednesday vote is not yet a Burns moment. The Fed retains the institutional capacity to reverse course at subsequent meetings, but institutional reversals in the history of central banking require either a change in leadership, a change in political environment, or a crisis so severe that the cost of continued accommodation exceeds the cost of tightening. The question the Wednesday vote leaves open, and it is the question that every market participant, every allied finance ministry, and every adversary treasury is now analyzing, is which of those 3 catalysts arrives first, and whether it arrives before the inflation expectations that Burns allowed to become unanchored in 1973 become similarly embedded in 2026. The founders of the modern central banking architecture, from Walter Baughat, who articulated the lender of last resort principle in 1873, to Milton Friedman and Anna Schwartz, whose 1,963 monetary history of the United States established the definitive analytical case for rules-based monetary policy, shared a single foundational insight that the Wednesday vote appears to have temporarily set aside: that the credibility of a monetary institution is its most valuable and most fragile asset. More important than its balance sheet, more important than its technical expertise, and more important than the short-term political considerations that will always create pressure to compromise it. Credibility, once questioned, does not repair itself through statements of intent. It repairs itself only through demonstrated action, through the willingness to impose real economic costs in defense of the price stability mandate, even when those costs are politically inconvenient. The Wednesday vote was a deferral of those costs. Deferrals in monetary policy are not eliminations. They are accumulations. And what is not paid today accrues interest. And the interest on monetary policy credibility, when it comes due, is invariably paid by the people who can least afford it. The wage earners whose purchasing power erodes with each month of uncontrolled inflation, the savers whose retirement accounts are silently taxed by negative real interest rates, and the borrowers, sovereign and household alike, who discover that the cost of capital has risen sharply precisely when they most needed it to be stable. Watch the next 30 days of DXY trading with the 95 level as the critical threshold. A sustained break below that level confirms that the dollar weakness triggered by Wednesday's decision is structural rather than transient, and it will change every subsequent Fed calculation. Watch the IMF's emergency lending facility utilization, which is publicly reported and which will signal within 60 days whether the emerging market debt stress is moving from elevated to critical. Watch the next monthly Saudi Aramco invoicing disclosure for any increase in yuan-denominated contract volume above the 6% baseline established in 2024. Watch for the next Federal Reserve speech or testimony from a voting member who dissented on Wednesday, specifically whether the dissenter's public language escalates in urgency, which would signal that the internal institutional debate is not resolved and that the next FOMC meeting carries a higher probability of a policy reversal than the market currently prices. And watch gold, which is the oldest and most reliable thermometer of institutional monetary credibility, not as a trading signal, but as a real-time referendum by millions of individual actors on whether they trust the institution that manages the world's reserve currency to preserve its value. Gold at $67 above its Wednesday open is a data point. Gold sustained above that level for 30 days is a verdict. Subscribe, because the chain reaction that started at 2 p.m. on Wednesday afternoon is running through every market, every ministry, and every military calculation on Earth right now. And the decisions made in the next 30 days will determine whether it is contained or whether it becomes the event that rewrites the rules of the global financial order that has governed your savings, your prices, and your government's capacity to act for your entire lifetime.